Hello class, this is Dr. Fenton. I want to show you how to work another one of the homework Module 5 problems. So on this one, we're trying to figure out how much inventory do we need to purchase each month. Okay, and then they're going to ask about how much we need to pay for that cash each month. So the information here is, they have a budgeted cost of goods sold each month, April through July here. They've already computed this for us. This is the cost of goods sold we need to have based on expected sales. They do say also that they had beginning inventory of $4,500 on April 1st. So April 1st, beginning inventory, $4,500. Also, a beginning balance in accounts payable of $15,500. We're going to need this for Part C. And then they also tell us at the end of every month, they would like to maintain an ending inventory balance equal to 20% of the next period's cost of goods sold. Okay, think about that. At the end of a month, you want to have an inventory 20% of your expected cost of goods sold for the next month. Then it says on the purchases, all are made on account. The company paid 65% of accounts payable in the month of purchase, and the remaining 35% in the month following purchase. Alright, so Part A. Prepare an inventory purchases budget for April, May, and June. They give us numbers for July because we need that in the computation, but really we're going to work with just these three months for the second quarter. Okay, so here's Part A. Let's see where we get all these numbers. Well, first of all, in April, the budgeted cost of goods sold is $68,000. 68 drops in. And we can go ahead and see that May's expected cost of goods sold, you drop that in, as well as June. So all these are given to us. We're trying to find out how much do we need to purchase in each of these months. All right. So if we need $68,000 in budget cost of goods sold, plus, remember, at the end of any one month, we want to have 20% of the next month's cost of goods sold on hand. That means we need to have in inventory a total of $83,600 during the month. And so, where does this $15,600 come from? Well, 20% of the next month's cost of goods sold. So 20% of May's cost of goods sold, and I'll check it on my calculator, 78,000 times 0.2, there's 15,600. So this 15,600 is 20% of May's cost of goods sold the next month. I'm going to go ahead and go straight down this way instead of going across again. So we need to have a total of $83,600 of inventory. Now, do we have to buy all that? No, because we have beginning inventory already on hand going into April of $4,500. So we need in April $83,600. But we already have $4,500. Tells us right here. Subtract, and that means we need to purchase $79,100 during April to be able to satisfy the April amount needed, $83,600. We need to cover April's cost of goods sold. We need to cover 20% of the next month's. That gives us the total. We don't have to buy all this because we already have some on hand. We only need to purchase $79,100 at the end, during April. Do the same pattern for the next 2 months. This number is given to us. Where does the $17,600 come from? It's 20% of the June's expected cost of goods sold. So 20% times 88,000 is 17,600. Add these two, and that shows us that during May we need to have $95,600 of inventory. That's our need for May. Do we have to buy $95,600? No, because at the beginning of May we're going to have $15,600 in beginning inventory. Why? Where's this number come from? Right here. If we budget $15,600 for ending April inventory, that's going to be beginning May inventory. You can see the same thing happens over here, May to June, right here. Okay. So we only have to buy $80,000 of inventory during May. Cost of goods sold. Let's cover our desired ending inventory, 20% of the next month's sales. Total needs, $95,600. We don't have to buy $95,600 because we already have $15,600 on hand. We only have to purchase $80,000. Okay. The last month, same pattern. This is given to us. You see, well, there's no column here to get this from. That's why they give us this July amount. So 20% of $94,000 drops in here. We're only doing this for the quarter, but we need this number. So 20% times 94 is 18,800. Add, we need 106,800. Do we have to purchase $106,800 of inventory this month? No, because we already have $17,600 on hand. Subtract, that means we only have to buy $89,200 in June for our inventory. Part B is saying, okay, determine the amount of ending inventory, fanning report on the end of quarter pro forma, or really, budgeted balance sheet. We've already done that right here. At the end of June, we want to have 18,800. And so there's the answer, 18,800. Now for Part C, prepare a schedule of cash payments for inventory for April, May, and June. We computed back in Part A what we need to purchase. But now we're worrying about the cash flow, all right? So how much cash is going to be paid out? Well, going back up to here, it says the company pays 65% of accounts payable in the month of purchase and the remaining 35% in the month following purchase. So let's look at this. This says that the payment of current accounts payable in April, let's see where we get this number from. Let's go back here to requirement A. We have $79,100. I'll do it on my calculator, $79,100. And it says we expect to pay 65% of that in that same month. The month of purchase, you pay 65%. So 79,100 times 0.65, there is $51,415 right here. So this is 65% of the expected purchases in April. Okay. This number was given to us right here. Going into April, we had accounts payable, and that's really the 35% left over from the previous month in March. But anyway, they gave it to us. So in April, cash going out the door for inventory is $66,915. 65% of the current month's purchases and 35% of the previous month's purchases. Total $66,915. May, same thing. Let's go back to here. Let's take 80,000 times 65%. There's $52,000 of May's purchases that we're going to pay for in May. There it is, $52,000. Now this shows us that we are also going to pay 35% of the April purchases. So go back to requirement A, April, 79,100 times 35%, and there's the 27,685. This number is 35% of April purchases. We're going to pay that in May. So in May then, cash going out the door will be 79,685. 65% of the May purchases and 35% of the April purchases. And do the same thing for June. I'll let you figure this out yourself. Same pattern. Okay. So let's see. Part D. Determine the balance in accounts payable, fanning report on the end of quarter pro forma balance sheet. Well, that's going to be 35% of June's purchases that we've not paid for yet. Right here. And I think they show us that calculation down here. Yes. So go way back to here. Here are our June purchases. And I'll just do this myself also. 89,200 times 35%. 31,220. And that's the amount that we're going to owe at the end of June. Okay, it's June's purchases times the 35% we've not collected yet. We're going to collect this in July, $31,220. Okay, that was a quick explanation of this problem, and so I hope this helps.